Hey everybody, I'm John VanDuzer, CPA and partner with James Moore and Company. I'm here with Kevin Golden, CPA and director with James Moore and Company, and we're talking about year-end tax planning for real estate professionals. So this is the third video in our series, so check out our other videos. We did a video on retirement plans and also taking advantage of the cash basis accounting. And now in this video, we want to cover some common deferrals whenever you have a sale and just kind of jog your memory a little bit on those in case you're contemplating a transaction before the end of the year. So Kevin, why don't you tell us about like-kind exchanges?
Sure. Yeah, John, like-kind exchanges are something we've actually gotten a lot of questions about recently. And every year as we hit this time of year, several clients have questions about that. So like-kind exchanges, usually whenever you have a piece of real estate that you're going to have a large amount of gain in, maybe because you've held it for a long time, maybe just because you happen to buy it at the right time and have done a good job handling the property, and you're going to incur a large amount of gain. Well, there are provisions in the IRS code that allow you to defer that gain through what's called a like-kind exchange or a 1031 exchange. To do so, you have to, after the closing on the sale of the current property, you have to identify the new property that you're going to basically roll everything into within 45 days, and then you actually have to close on that property you've identified within 180 months, or excuse me, 180 days. So in doing so, you have to use what's called a qualified intermediary to basically make sure you jump through all the hoops to make sure you qualify for full deferral. But what it does is it allows you to take any gain that you have that you would normally pick up as income and pay tax upon it and defer it into the future property. And so at some point in time in the future, when that property sells or you do something else with it, you eventually will incur that gain, but it kicks it down the road to a future tax year and is a great way to help defer taxes from this year into a future year. Now, one other tool we use is called a qualified opportunity zone. John, why don't you tell us a little bit about those?
Yeah, absolutely. So a qualified opportunity zone was a provision that was put in the 2018 Tax Reform Act called the Tax Cuts and Jobs Act. It is a special incentive for redevelopment in lower socioeconomic areas. And so there's actually a map, and you can go find that out on the internet, that was designated by the governors in each state that created these opportunity zones. And there's a lot of details and a lot of specifics in those opportunity zones, but the gist of it is if you invest capital gains into an opportunity fund, you can defer those capital gains for up to 10 years, as long as you don't sell the property or divest of the fund. At the end of 10 years, you recognize a portion of those capital gains, but a portion you do not have to recognize. And then going forward, any capital gains from the sale of that property ultimately would not be taxable. So it's a really, really good deal. It's a good inducement to invest in those areas. It also had similar timelines. So kind of like a like-kind exchange, it had a 180-day time frame from the time that you generated those capital gains until you could invest in a qualified opportunity fund, but had a lot less restrictions in that you didn't have to use a qualified intermediary. If you sold within an entity that was a flow-through entity and it passed through to you personally, you could make the investment in the entity or you could make it personally. So there's a lot of flexibility there, which was by design in order to induce those investments. But this year is somewhat unique as a result of COVID because the IRS, when there was a large national type quarantine and staying home, the IRS extended a lot of deadlines, including investments into an opportunity fund through July 15th. And then the IRS has recently come back again and extended that deadline through the end of the year. So this is a really unique opportunity in that you could have had a capital gain in January, missed the 180-day window there in the middle of July as far as making that investment into an opportunity fund, but now you have through the end of 2020 in order to make that investment. So, as the year is taking shape and you're looking at your tax situation, it may make sense to go ahead and invest in a qualified opportunity fund as kind of a last minute move in order to reduce your tax liabilities for 2020. So that's just one thing that we're looking at. Kevin, why don't you tell us about installment sales?
Sure. Yeah. So let's continue down the capital gain theme here. So installment sales are basically sales of property that generate those capital gains that we've been talking about. So normally, whenever you sell a piece of property, as soon as you sell that, assuming you don't do anything like an opportunity zone or a 1031 exchange, again, you incur that gain immediately, you pay tax upon that. However, a lot of people who are buying these properties, they're going out and getting loans on them from the bank, especially with the rates as great as they are right now. So instead, one option you may want to look into is becoming that creditor of that bank yourself. In other words, doing a seller financed property. So when you sell a property, now essentially instead of being paid up front for that, you're going to be paid out over time, no different than a bank or other creditor would be. Obviously, that imposes its own risk associated with that, but a tax benefit of doing that is you basically pay tax as you go. As you collect money on that loan, whether it be a down payment or loan payments in the future, you're going to pick up that gain as you go along instead of all at one time. So again, it's a great tool to help space out that income over the years. However, do caution, you do become a creditor at that point and the risk associated with that. But on top of all that, you can also collect some interest along the way. Assuming you've got a good buyer and someone who pays timely, you can also collect additional income on that along the way, which is just yet another benefit beyond just selling it outright. So installment sales can be a great tool, again, to defer additional income to a future year. So, well, that's all we have time for today. We really appreciate everyone listening about our deferral methods and to our other webinars as well. Really appreciate it. If you can check us out at jmco.com. Thanks and have a great day.